Hello and welcome back to The Note. Let's talk today about growth. There's a lot of confusion about it at the moment, not least because we had two separate revisions of the latest ISM numbers out of the US earlier this week. Not only that, but if you look at markets, the bond market is plainly signalling that growth is going to slow down, while the stock market appears to be much more optimistic. Who is right? With me now to answer that question is the co-founder of Absolute Strategy Research here in London, Ian Harnett. Ian, thanks for joining me once more.
Hello, John.
Let's start by taking a quick look at the ISMs, which generated confusion earlier this week. Everything is set so that 50 is the dividing line between contraction and expansion. What do they tell us at the moment, if anything, assuming the latest number is right?
I think that we would still feel that the positive tenor is definitely there. But as you can see, whereas you'd had a very uniform upturn in the, perhaps that 2013 first half, it's now getting a bit more confused. We're just lost in that transition between, is it growth, is it, a bit more slowdown, and that's where you're seeing this confusion in the asset class.
Okay, so there is some reason for confusion. Now let's take a look at a chart that you provided, which takes a closer look at some asset classes that are normally very sensitive to.
Because I think the thing is that the bond market is, a lot of people in the bond market are saying that the bond yield's down at, really historic lows for many economies. It's telling you that we're on the edge of recession again. We're on the edge of deflation, and that's what Mr. Draghi is worried about going into the ECB meetings. What we're trying to show here, though, is that, watch out, because at the moment, bonds are very heavily overbought. And if we take the example from what you've seen in commodity prices in the past,
which have been staging a decentish recovery
over the last 6 months, they're up almost 10%. A lot of people have missed that. Then that's telling you that in the next 6 weeks, we could actually see those break-even inflation rates, which had been coming down, start to rise again. And that's the reason why we think this is a great opportunity to actually sell your bonds rather than enhance that bond position.
Okay, but it also leads to interesting questions about equities, because then the possibility of a hawkish surprise from the central banks comes back on the table. Let's have a look. This is a fascinating chart where you break down the relative performance of value and growth strategies within the equity market against changes in the bond yield. Is there a safe bet anywhere here, regardless of the level of growth?
Well, I think that what it tells you is that if we do see those bond yields back up, then the most likely outcome is that value is going to start to outperform growth once again.
Because we're actually seeing growth, because growth becomes the thing that's in big supply and value is the thing that's in less supply?
Absolutely. And you're returning to what we would call fundamental markets. And fundamental markets are exhibited when the cheap things go up most. And value is the cheap area of the market.
So, but assuming we're wrong that we do have a few more bad numbers, we've also got US unemployment data before the end of this week. It's a busy week. Is there still some safety in value as opposed to growth?
Well, that's where you actually get the safety comes from the valuation side. And one of the things we've seen, one of the reasons why we saw that sell-off, particularly in US growth, was that the valuations have started to get a bit toppy. If you miss some of those earnings numbers, then your equity performance comes under a lot of pressure. When you've got a relatively modest valuation, you can absorb some of that pressure.
Okay, Ian, thank you very much indeed. So I don't think we've resolved for you quite whether the world economy really is going to grow, but I do feel quite comfortable with Ian's recommendation that it does make sense at this point to head for value rather than growth stocks.